I mean, if you want to go and just, say history is history and it's never different this time, we're supposed to say that you're right, Mike, that we're in a recession right now. The curve's already priced it in. Inflation's the rising oil prices and home prices will slam the economy down. And equities have already had their pullback and time to buy them. I mean that is what the market, the numbers are saying.
This is where I actually would interpret that quite differently. I think what the market has priced is a broadly sensible platform that says, if we don't screw things up too badly, this is the expected path. The problem, I would argue, is exactly what you're articulating, which is that you do have a heavy-handed Fed that did a poor job of building expectations for what the likely path was last year, and is now politically forced into a situation where they're hiking interest rates and are going to cause all sorts of economic chaos. I mean, the underlying dynamics of the number of companies whose capacity could come offline because they are effectively zombified, right? The dynamics of rising prices in online shopping, for example, is only going to be exacerbated if we actually end up seeing commercial real estate liquidated, right? So many of the retailers that we're seeing that have massively overstocked their inventory levels, and people can point to things like retail inventories and say they don't seem that elevated, but that's tied to one very specific sector, which is the automotive sector, right? Where we're functionally constrained in terms of our production capability, and prices have been pushed to a level that allows demand destruction to occur. Every other sector of retail is showing explosive growth in inventories. All right, and that could very easily reverse itself. And then some, if we have much higher interest rates that prevent the serviceability of that debt. Like, I think that what we're actually looking at is a political environment. And Lyn, I'd be interested in your take on this. Harley referred earlier to the idea that perhaps what we went through in the 2010s was much more like what we saw in the 2020s, or 1920s, I'm sorry. And what we're facing today, because we forestalled the cleaning of the system, is some variant of Joe Manchin saying, liquidate stocks, liquidate labor, et cetera. Let's be sensible in our household operations.
I think that's one of those things that can work for periods of time. But I think that when debt across the board is this high relative to economic output that supports that debt, I think that they're going to quickly, if you start to get massive liquidations of that debt and basically just broad solvency crisis, I think politician tunes are going to change pretty quickly. One of my theses is that I think that we are going to eventually see more fiscal stimulus, but it's going to be more targeted than the prior rounds. I think we could see what's happening in Europe, where you get energy stimulus, for example, and we already see that in some states where you take away some of the taxes on gasoline to try to make it more affordable. I think you're going to see things like that going forward, where you get rising discontent to the extent that a stagflation environment continues. If new energy supply is not coming online significantly, and if they're trying to engineer demand destruction, that's going to manifest in a weaker labor market, a weaker consumer market, rising voter discontent, rising donor discontent, and then I think that reverses itself. Now that, of course, the path dependency matters. And so until we see the whites of that eyes, basically, I think it makes sense to be more defensive here, but defensive in my view means preparing for the possibility of recession, but not necessarily one that's as disinflationary as the prior ones are. I think that we could see I would expect to see a lower number than 8%, but I'm with Harley that it's not going to come down quickly, mainly because of what we're seeing on the energy side and what we're seeing on some of these areas. But you can have certain pockets that are very disinflationary due to high inventory and overproduction on some categories.
Now, when you think about something like tips, for example, you mentioned this idea of the oil forwards. You don't actually hedge a 5-year inflation tip with a 5-year oil forward, right? You wouldn't actually use that component to hedge that. You're using the much nearer term, and nobody actively trades tips on an arbitrage basis on that manner. If I look at those forwards in oil, right, and I would agree with you that the kind of 5 years out, we're looking at $75 a barrel. I don't expect that either, right? But if we were to see a 50% increase in that, that would have the inflation component of oil effectively be zero. Right? Nobody's hedging their oil out that far except for a very few number of producers. And even there, the balance sheet intensity is not really there. That's part of the underlying dynamic. There's just less demand and less supply out there. So when you think about that, like, what's wrong with a 50% increase? Do you think it's significantly higher than that? Do you think we're looking at $200 oil in 5 years?
I think when we look out 5 years, those numbers are realistic, those higher numbers, 200. I wouldn't be surprised if not only are those futures end up being too low, that even the current price is too low. Now, the path to get there could be, we go up to 120, we come back to 100, we go up to 150, we come back down to 110, we shoot up to 180. I don't know what the path is going to be. It's not going to be a straight line. But I do think that we are entering the realm of a serious possibility of a crisis, of just not enough energy when you have Europe, China, Japan, US fighting over. And over time, you can also get some of these things arbitrage. So right now, European natural gas prices are way higher. Natural gas is a less fungible market than oil because the shipping costs of that are just much more complex. And so there's some arbitrage, but there's less capacity to arbitrage that than with oil that is far more fungible. Over time, to the extent that those spreads in prices persist at that level, you're going to see more and more North American natural gas want to go to Europe to take advantage of that, more export capacity be built. And so that can raise the prices on Americans as well. And so I think across, not just oil, but natural gas and just all the kind of the whole energy complex, I think it's probably going to be higher than people expect this decade. Even though, again, the next 6 to 12 months, I have no clue what oil is going to do. But I think the longer you look out, I would take the over on pretty much any estimate.
Lyn, so, and I hate politics on the show, but who's the bigger oil bull, Biden or Putin?
You mean in terms, so
Who's going to who's going to take oil up? Biden by limiting supply, or Putin by fighting a war? I mean,
so I think, they're both huge variables. If you would have asked me my prediction before the war, I probably would have, whatever numbers I just said would be a little bit lower before we added actual kinetic war to the mix. So that's certainly a variable. I think in the long run that gets arbitrage because they build pipelines to China. China takes more of that. I don't think we're going to see a ton of Russian oil leave the market in the very long term, but it does add friction and risk premium to this whole thing. I think the bigger story is the lack of, part of it's geological. I think OPEC is just kind of getting somewhat tapped out in their overall ability to ramp up production. I think shale has, gotten the 80% of the easy gains over the past decade. I think, squeaking out further new supply per year is harder. So I think a lot of it, I think the biggest bull in the room is kind of just physics. But then, yeah, when we add ESG, Biden policies, things like that, that is super bullish. And then Europe's, it's kind of like this ideology where you're getting the price spikes, but you're just not getting that response right away. And I think that's got to persist until voters change, right? I think it's one of those things. People don't change their viewpoints on a dime, and so I think it's going to be a problem both in Europe and the United States for years. So I think it's multiple aspects there.
well, I'm asking because if Martians came down and took Putin and carried him away, so he's totally out of the picture. I think the market's pricing in oil down 40 points the next day, right?
That's one of the reasons I say next 6-12 months, no idea, because there's headlines that could move it, like you said, massively. If that gets resolved, I think that buys us time. I think that takes out a significant problem for 6 months, 12 months. But it doesn't really change the fact that shale's not really, ramping up. OPEC is, usually OPEC's problem is trying to keep the countries from overproducing. Whereas in this environment, a lot of them have not even been meeting their quotas, despite the fact that oil prices is high. And so I think that just in multiple areas of the world, there's just not a lot of capex coming online, and that there are just, significant limitations to how much oil can be produced in a period of time. And no one wants to invest in like these 7 to 10 year offshore projects. We're not seeing a lot of that right now. I think that could change eventually if you get high prices for long enough. that can change. We already see some countries changing their policies, like India. Just they come out and say energy security is now a bigger focus for us, right? So countries that have less margin for flexibility, generally lower GDP per capita, they're going to be they're going to be just more like practical in terms of changing their outlook on things. I think it just takes more time for some of the developed markets to have that change.
Yeah,
So
Mike, does her view change yours on inflation? Because if we're getting oil 200, not only does, the gas at the pump go up, but the input price of energy is, flows on through. I mean, if she's right, or do you, I mean, if you think she's right, would that change your view of the world?
Not meaningfully, unfortunately, right? And for a couple of reasons. One, I don't see the demand being as inelastic over the time period that Lyn is referring to. So part of the dynamic that we've experienced has been an extraordinary recovery in the global economy in a very short period of time. It's actually remarkable how similar the oil price increase is, obviously correcting for the negative oil prices in May of 2020. It's remarkable how similar this looks to the recovery from 2008 to 2011, for example. And I would argue that we're running into the same underlying dynamic. The 2003 to 2008 cycle was largely driven by China's globalization and its emergence as the manufacturing sector for the world. That required a ton of oil, it required a ton of gasoline, it required a ton of diesel, it required a ton of commodity investment per capita. In a world in which global population is not growing in that way, when the participants in the global labor force are not changing in any meaningful framework, I struggle with the durability of that. And we also see, to Lyn's point, and this I actually totally agree with, if we end up seeing significant subsidies within developed markets, which we're starting to see in particular, then we will see those developed markets show higher inelasticity, effectively lower elasticity, reduction in demand versus high prices. And that's going to put it all onto the developing world, which is where I'm really concerned about the dynamics, right? Because that is where we're seeing a significant restructuring of economies. They're being forced to by the dynamics that Lyn is hitting on. Oil is an inconvenience in most of the developed world. As painful as that is to acknowledge, like it pisses me off to pay $100 to fill up my gas tank, but it doesn't change my behavior that dramatically. It does start to change marginal behavior pretty dramatically for most Americans because we're talking about a fairly significant increase. And I've shared things like the increase in food and gas prices. But if I look at the developing world, which is where all of the incremental growth in demand has been happening for the past 20 years, we really are seeing the risks that is cut off very, very hard. I mean, people forget that the average Chinese college graduate makes somewhere in the neighborhood of $700 a month, right? This is not a country that can handle significantly higher energy prices.
And with India, it's even less. Their oil per capita consumption is less. Their GDP per capita is less. Same thing for large portions of Africa. There's very large swaths of the world where, and it's not just the energy costs. It's also how that trickles into food costs.
Oh,
And
I
that's where,
totally agree.
yeah.
And that's why I've been highlighting places. I mean, I don't have a Malawi fetish, right? But I keep highlighting Malawi as a great example. And Malawi just devalued their currency by 25%. That's just another way of saying we, as Malawians, we no longer get to buy stuff from the rest of the world.
Lyn, what have we not asked you so far? What freeform topic you want to hit on before we close?
I think that covers most things. I think one of the biggest questions is what's going to happen with fiscal, because to the extent that they stay on course with no fiscal, Fed tightening, and what the public's kind of ability to withstand a recession is, then I think you could see a prolonged period of disinflation from a high level. It takes time to get down, right? So I basically very much sympathize with the disinflationary view here after being in the inflationary camp for a while. Where I think the breaking points is, basically if those foreign sectors are not growing, especially with the dollar so strong, it means they're not buying treasuries. It's a pretty strong dynamic that we see. It also means that credit markets are not going to be functioning very well. And then so it's kind of like, at what point does the Fed even if inflation's still running kind of high, what point does the Fed get to a part where they, job losses are ticking up and they have to kind of pause their tightening schedule to fight, despite the fact that inflation is still above their threshold? And, what point do you get a pain point in Congress to do something to try to address these energy concerns? Because they're already doing, they're already drawing down the Strategic Petroleum Reserve. What happens when that gets low enough that they don't want to go any lower? There are kind of these decision points that we have to look past and think that that's where there's a fork in the road where you can have another couple quarters of disinflation, or you can get a pretty serious inflation spike and an oil price spike, and as Mike pointed out, a lot of these developing countries stressed. So I think it's less about predicting what's going to happen and more about knowing what are the key variables to watch to know which direction on the road the probability is tilting to at any given time. I think that's probably the biggest takeaway, is to know what to look for about when to change views on things versus exactly what order and what time frame things are going to play out.